Bismillahirrahmanirrahim. This is the fifth video on formation of partnership. In this video, we will solve exercises on recording transactions using bonus and goodwill methods on formation of partnership. We will be recording general entries on initial investments, withdrawals, and closing general entries. We will solve exercises on calculating net income or loss amongst the partners. We will also solve exercises on recording general entries on admission of a partner under different conditions. We will solve exercises on how to prepare a schedule to allocate the net income under different conditions. And finally, we will solve exercises on recording general entries on revaluation of assets and withdrawal of partners under different conditions. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We hope this video helps CPA, AICPA, ACCA, CMA, Saudi Organization for Certified Public Accountant, that is SOCBA's training courses, and other accounting program aspirants. We also hope that this video helps fresh graduates who have joined the companies and want to refresh their learning on formation of partnership. Let us first solve an exercise on recording transactions using bonus and goodwill method on formation of a partnership. Now, John, Jeff, and Jane decided to engage in a real estate venture as a partnership. John invested 100,000 cash and Jeff provided office equipment that is carried on his books at 82,000. The partners agree that the equipment has a fair value of 110,000. There is a 30,000 notes payable remaining on the equipment to be assumed by the partnership. Although Jane has no physical assets to invest in the partnership, both John and Jeff believe that her experience as a real estate appraisal is a valuable skill needed by the partnership and is a basis for granting her a capital interest in the partnership. So Jane, she doesn't bring any investment, but she is accepted as a partner and granted capital interest. Assume that each partner is to receive an equal capital interest in the partnership. Record the partnership formation under the bonus method and under the goodwill method and assume a total goodwill of 90,000. So, we are going to look into the appropriateness of either the bonus or goodwill method to record the formation of the partnership. So first of all, we are going to record the investment by the partners in their fair value. Now, John, He invest 100,000 cash. So cash is under the heading of John's capital. Jeff don't bring any cash, but he brings in capital. He brings in equipment, and the fair value of the equipment is 110,000. So the total assets brought by the two partners in is 100,000 and 110,000. Then the notes payable is 30,000, and that is going to be deducted from his total assets invested by Jeff, and the net assets invested are 100,000 and 80,000. Now you can see that Jane has not made any investment, so that assets for Jane is 0, and the net assets invested are 0 by Jane. Then we have to record the partnership formation under the bonus method. So cash is debit by 100,000. Equipment is debit by 110,000, and there is a notes payable of 30,000. So the total assets are 210,000 and the liability is 30,000. That means the total capital is 210 minus 30, that is 180,000, and this will be allocated to the three partners equally. So 180 divided by 3, that makes 60,000 for each partner under the bonus method. Then we will be recording this under the goodwill method, and goodwill has been determined as 90,000. So goodwill is debit by 90 now. Cash is 100,000. Equipment is 110,000. And notes payable is 30,000. So the total assets are 300,000 minus the notes payable, so that gives us 270,000, and this will be distributed among the three partners equally, that is 90,000 each. I have put this information, okay, and then we have the part C to discuss the appropriateness of using either the bonus or goodwill method. So the bonus method is used when John and Jeff recognize that Jane is bringing something of value to the firm other than the tangible assets, but they do not want to recognize an intangible asset. So that's why under the bonus method you don't see any goodwill over here. And under the goodwill method is when the partners recognize the intangible nature of the skills of Jane, who is bringing into the partnership. However, the capital account are equalized by recognizing an intangible asset and a corresponding increase in the capital account of the partners. So that is what we have done over here. I have put this solution in an Excel sheet in case you find difficult to read my handwriting. Next, let us solve an exercise on recording journal entries on initial investment, withdrawals, and closing journal entries on income. So Tom and Julie, they formed a management consulting partnership on January 1, 2008. The fair value of the net assets invested by each partner follows over here. So these are the investments and there are some liabilities as well. During the year, Tom withdrew 15,000 and Julie withdrew 12,000 in anticipation of operating profits. Net profit for the year was 50,000, which is to be allocated based on the original net capital investment. So we have to prepare journal entries to record the initial investment in the partnership. So first of all, we are going to record the investment by Tom, and Tom brings in 13,000 cash. So cash is debit by 13,000. He brings in accounts payable for 8,000, office supplies 2,000, office equipment 30,000. There is accounts payable of 2,000. So the total assets that are invested by Tom is 53,000 and there is a liability of 2,000. So the balance, that is 50,000, will be recorded for Tom's capital. Next, let us record the journal entry for investment by Julie. And Julie, she brings in 12,000 cash, accounts payable 6,000, office supplies 800, land, she brings in land for 30,000. There are no office equipments by Julie. And then we have accounts payable of 5,000 and mortgage payable of 18,800. So if you make the total of the assets, the total of the assets is 48,800 and the liabilities of Julie, she brings in, is 23,000. So the Julie's capital will be 48 minus 23, 23,800. So the capital is going to be 48,800 minus 43 minus 23. So that is 25,000. So we have made the initial investment, that is record the initial, we have recorded the initial investment, and then we have to record the withdrawal, and the two partners are withdrawing 15,000 and 12,000. So Tom's drawing is debit by 15,000 and cash will be credit by 15,000. For Julie, it is 12,000 and cash will be credited by 12,000. So then we go to number 3, close the income summary and drawing account. And the income summary states that the profit is 50,000 and this profit of 50,000 will be distributed among the partners in their profit sharing ratio. So we have 51 plus 25, that makes 76. So we have a total of 76,000 and the capital of Tom is 51. So this is equal to 33,553. So income summary is debit by 50,000. Tom's capital is 33,553 and the balance will be given to Julie, that is 16,447. And then we have to close the drawings as well of 15,000 and 12,000. So Tom's capital is debit by 15 and Julie's capital by 12, and that's how we close the drawing account. Next, we prepare a statement of changes in partners' capital for the year, that is December 31, 2008. So there is no beginning balance, so that becomes 0. Then Tom brings in a capital of 51,000 and Julie brings in a capital of 25,000. So that makes 76. And then we have allocated the net income over here, 33,553 and 16,447, that makes 50,000. So the total is 84,553 and 41,447, that is 126,000. And then we are going to subtract the drawings, and the drawings were 15,000 and 12,000, 41,447, and this is 16,447. And sorry, 15,000 and 41,447, and for Julie the drawing was 12,000. This will be subtracted, so we will subtract a total drawing of 27,000. So the capital balance is 69,553 for Tom and 29,447 for Julie, and you can see that 126 minus 27 will give us 99,000. I have put this exercise in an Excel sheet again in case you find difficult to read my handwriting. Next, let us solve an exercise on calculating net income or loss amongst the partners. So Jones, Silva and Thompson form a partnership and agree to allocate income equally. After recognition of 10% interest on beginning capital balance, so there is a interest on capital, and there is a monthly salary allowance of 2,000 for Jones and 15,000 for Thompson. There is nothing for Silva in this case, and the capital balances are as follows. Now we have the net income or loss to be allocated under each of the following independent situations. Okay, so we have the interest, and the capital of the three partners was 40,000, 25,000 and 30,000. So this makes 10% is 4,000. Silva's will be 2,500, and for Thompson the interest on capital will be 3,000. So the total will be 9,500. There is a salary of 2,000 per month for John. So for 12 months this will be 24,000. Nothing is to be paid to Silva. And for Thompson 1,500 per month, that makes 18,000 annually. So the total salary paid is 42,000. So the total is 28,000. Sorry, the total is 28. Then we have 2,500, and then we have 21. So that is total is 51,500. And the net income in the first case is 99,500. So the balancing figure is to be distributed is 48,000, and this has to be distributed equally, so divided by 3, that makes 16,000 for each partner. And the income allocation is 28 plus 16, that makes 44, 18,500 and 37,000 in the first case. In the second case, they say net income for the year is 38,300. So we have now 38,300. There will be no change as far as interest and salary is concerned. So we simply put the total over here as 28,000, 2,500 and 21,000. So the total of the three is again 51,500. And now the difference is of, now this will be minus 13,200, and this will be distributed among the three partners equally, that is 4,400 each. Now this is going to be reduced, so the income allocation is 23,600, 1,900 and 16,600. We go to the third case. The net loss for the year is 15,100. So again we have the same values over here, 28,000, 2,500, 21,000 and 51,500. Now there is a loss, so loss is 15,100. That means the value over here, the balance will be 66,600, and this will be shared by the partners equally, that is 22,200, 22,200, 22,200. So this will be in brackets because these are losses to be reduced. So the net loss allocation is 5,800. This will be negative 19,700. You can see that the capital in partnership can show a negative balance as well. And then we have 1,200. Okay. So, and once again I have put this solution in an Excel sheet in case if you find difficult to read my handwriting. Next, let us solve an exercise on recording journal entries on admission of a partner under different conditions. So, Phil Phoenix and Tim Tucson are partners in an electrical repair business. Their respective capital balances are 90,000 and 50,000, and they share profit and loss equally. Because the partners are confronted with personal financial problems, they decide to admit a new partner. So they are bringing in a new partner. After an extensive interviewing process, they elect to admit Don Dallas into the partnership. Now, we have to prepare the journal entry to record the admission of Don Dallas into the partnership under each of the following conditions. First one is Don acquire 1/4 of Phil's capital interest by paying 30,000 directly to him. That means nothing is coming in the business, so he will simply, and he is acquiring 1/4 of Phil's capital, and Phil's capital is 90,000. So 1/4 of this amount will be 22,500. So Phoenix capital will reduce and Dallas will be credited by 22,500, and we don't care how much he is paying directly to the partner. We go to the second one. Don Dallas acquire 1/5 of each of Phil's and Tim's capital interest. So 1/5 of 90,000 and 1/5 of 50,000. So 1/5 is going to be of 18,000 and 1/5 of 50,000 will be 10,000, and the capital will be credited for Dallas by 28,000. And again, you see, because he is paying directly the amount, so we don't care how much he is paying. Then we go to the third one. Don acquire 1/5 capital interest for a 60,000 cash investment. You see, now he is making an investment into the partnership firm. He brings in 60,000 and he is acquiring 1/5 of the capital interest. So for the old partner, the capital is 90 plus 50, so that is makes 140, and plus 60,000 that is brought in by Don. So the total capital is 200,000, and he is acquiring 1/5 of this amount, so that makes 40,000. Now he brings 40,000 cash into the partnership, but he is getting only 40,000. So the capital of the old partners will be credited because their capital will increase by this amount, and they are doing it equally. So that's why 10,000 each of the difference, and that is 10,000. So that's how we record the acquisition of 1/5 of capital interest by cash investment. We go to the fourth one. Don invest 40,000 for a 1/5 interest in a partnership capital. Now here you see implicit, it is implied, and goodwill is to be recorded. So if you can remember, Don brought in 60, but he is getting a share of only 40. That means there is a goodwill of 20,000, and the old partner's capital account will be credited by 10,000 each, as they are sharing profit and loss equally. And the capital for Dallas will be credited by 40, and cash will be recorded as 40. Okay. Once again, I have solved this exercise over here, and you can go through it if you find difficult to read my handwriting. Let us solve one more exercise on recording journal entries on admission of a partner under different conditions. Now here there are three partners: Beth, Step, and Linda. They have been operating a small gift shop for several years. After an extensive interview of their past operating performance, the partners concluded that the business need to expand in order to provide an adequate return to the partners. The following balance sheet is for the partnership prior to the admission of a new partner, Mary. So she is a new partner, Mary. And the balance sheet prior to her admission was as follows. Now prepare the necessary journal entries to record the admission of Mary in each of the following independent situations. Some situations may be recorded in more than one way. Okay, so Mary is to invest sufficient cash to receive a 1/6 capital investment. So she is going to bring in sufficient cash to acquire 1/6 of the capital interest. The parties agree that the admission is to be recorded without recognizing goodwill or bonus. Okay, so first of all we will calculate the investment, and he is going to acquire 1/6. That means 5/6. The remaining capital is how much? Is 600,000. So 5/6, so is 600,000 times 6/5 for the total capital. So the total investment is 720,000. And Mary is, so the total investment is 720,000, and Mary's investment is 1/6 of this amount, that is 120,000. So cash is debit by 120,000 and Mary's capital is credited by 120,000. Then Mary is to invest 160,000 for a 1/5 capital interest. Now, the book value of the interest acquired, if you can remember the first one, that is 600,000 for the old partners plus 120 by the 160 by the new partner, that makes 760, and of this she acquires 1/5, so 1/5 is 152,000. So you can see that the book value acquired by the new partner Mary is less than what she has invested. She has invested 160,000. So the bonus now will be given to the old partners, and the total bonus will be 160 minus 152, that is 8,000. And this will be distributed among the partners in the profit sharing ratio. So Mary brings in cash 160,000 and she is given a share of 152,000. The remaining balance of 8,000 will be distributed among the three partners in their profit sharing ratio, that is 2/5. So this will be 3,200, 3,200, that is 2:2:1. So 1/5 will be 1,600. Now if we apply, so this was if we follow the bonus method, but if we apply the goodwill method, then the total capital implied by the contract, you see this is 160 for 1/5. So that means 160,000 divided by 0.2, 1/5. That is going to give us a total capital of 800,000. Now from this we are going to subtract the current balance, and the current balance was 600,000 plus Mary's investment of 160,000. So that makes 760. So the difference is the goodwill, and the goodwill is 40,000. And this will be distributed among the existing partners. So goodwill is debit by 40, and this will be distributed again in their profit sharing ratio. So that is 16,000, 16,000 and 8,000. For Mary's capital, it will be 160 and 160 over here as well. So this was the second part, and let us look into the third part. And in the third part they say that Mary is to invest 160,000 for a 1/4 capital interest. Okay, now when it is 1/4, so the book value acquired will be, you see the old capital is 600,000 plus 160, that is what the new partner brings in, and she gets 1/4 of this amount, so the total will be 190,000. So that means now the book value acquired is more, because she brings in 190 but she is allocated 190, so she is getting more. So cash she brings is 160,000, but Mary's capital is going to be credited by 190,000, and the difference of 30,000 will be borne by the existing partners in their profit sharing ratio. So that will be 12,000, 12,000 and 6,000. Okay. Next, if we follow the goodwill method, then again the goodwill that is implicit in the agreement. Now the current partner's capital account is 600,000, and Mary is to invest 160 for a 1/4 capital interest. That means 1/4 means 25%, that means 75, this is 75% of the capital. So the total capital will be 600,000 divided by 0.75, that gives us 800,000. Now the implied total capital is 800,000, and the current balance of the existing partners is 600 plus Mary's investment of 160, that makes it 760,000. So there is a goodwill of 40,000. Now cash will be debit by what Mary brings in, that is 160,000, and then there is a goodwill of 40,000, and Mary's capital is going to be credited by 200,000. Okay. Next, we are going to look at the book value of the interest acquired in case number 4. Mary is to invest 160,000 for a 40% capital interest. So when it is 40, that means we already have 600 plus 160, that is what she brings in, and 40% of this amount will be 144. Okay. Now the book value of interest acquired is, 40% of this amount. Let me calculate. So this is going to be 600 plus 160 times 0.4. So this will be 304,000. Now Mary invests 160 and she is allotted 304. That means there is the book value acquired is more than what 600 plus 160 times 4, that will be 304,000. She acquired 304,000. So book value acquired is more than what she has invested, and she has acquired 144,000 more. So again, Mary's capital will be credited by 304,000. She brings in cash of 160,000, and this 144,000 will be taken care by the existing partners, so their capital accounts are going to be credited in the ratio of 2:2:1. So that will be 57,600, 57,600 and 28,800. If we follow the goodwill method, then the old capital is 600,000 and the new partner is acquiring 40%. That means this is 60%. So the total capital is 1 million. And the current balance plus Mary's capital is 760,000. So there is a goodwill, and the goodwill is for 240,000. So cash that Mary brings in is 160, goodwill is 240, and Mary's capital is credited by 400,000. So if you look into the second example and the third one, in the second example the book value acquired was less. $150,000, and here the book value acquired is more because she acquired 190,000. So if the book value acquired is less than interest acquired, so under the bonus method, old partners capital account are credited in their profit sharing ratio. You can see over here. But if the book value acquired is more than the interest acquired, then under the bonus method, old partners capital account are debited. You can see over here the old partners capital account is debited in their profit sharing ratio. Okay. Once again, I have put this exercise in an Excel sheet, and if you find difficult to read my handwriting, this is part 1, part 2, part 3 and 4. Next, let us solve an exercise on how to prepare a schedule to allocate the net income with bonus under different conditions. Okay. Now, the partnership agreement of ABC Associates provides that income should be allocated in the following manner. Each partner receives 20% of beginning capital. Sue receive a salary of 25,000 and Josh receive a salary of 21,000. Josh also received a bonus of 10%, and the residual amount is to be divided equally. The partnership's net income for 2008 was 90,000. This is the net income of the partnership firm. Beginning capital are 30 and 40. Now we have to prepare a schedule to allocate the net income under each of the following independent situations. Bonus is to be based on income before any profit allocation to partners. So this is the first situation. So interest on beginning capital, we have the beginning capital of Sue of 30,000, and for Josh it is 40,000. So interest on capital, that is 20%. So 20% will be 6,000 and 8,000 respectively. So that is total will be 14,000. Then salaries are paid of 25,000 and 21,000. So the total is 46,000. And then bonus is based on income before. So bonus is 10% and that is only for Josh. So 10% of the income, that is 90,000, will be 9,000. So this makes a total of 31,000, 38,000 and 69,000. Now the net income was 90,000, and of this amount the balance is going to be 21,000, and this will be distributed among the partners equally. So that is 10,500, 10,500 each. And now we have 41,500 and 48,500, and the total must be equal to 90,000. Okay, we go to part B, and bonus is to be based on income. Now it is after. So we will be calculating. So bonus is after subtracting the bonus but before allocation to partners for interest and salary. Okay, so we don't know the bonus, but what we know is the formula, that is 10% of profit minus bonus. So the bonus is 9,000 minus 0.1b. So 1.1b is equal to 9,000, or bonus is equal to 8,182. So again we have the same. Interest on capital is 6,000, and for Josh is 8, that makes 14, 25 and 21, that makes 46, and the bonus to Josh is 8,182. So we make the total, and the total is 31,000, 37,182 and 68,182. Now the net income is 90,000. So now the balance is 21,818, and this will be distributed equally. So 10,909, 10,909, and this will be 41,909 and 48,091, and once again the total must be equal to 90,000. Okay. Next we go to part C. Bonus is based on income after subtracting the bonus, interest and salary. You see, this is after, this was before. So once again the bonus is 10% of net income minus interest on capital minus salary minus bonus. So bonus is 0.1. We know the net income is 90,000. and the interest is 14,000. The salary is 46,000 and we don't know the bonus. So bonus is equal to 0.1 times 30,000 minus B. We just solve the equation. So B is equal to 0.1, that makes 3,000 times minus 0.1B. So 1.1B is equal to 3,000, or we can say that B is equal to 2,727. So now the bonus, let us calculate. Now the interest on capital again is the same, 6,000 and 8,000, that makes 14. Salary paid is 25,000 and 21,000, that makes 46. And the bonus of 2,727, there is no bonus for Sue, so the total is 31,727, and here the total will be 62,727. Again we have the net income of 90,000 and the balance now is 27,273, and this will be distributed among the partners equally, that is 13,636, and this will be 13,637. Why this 7? Because the total must be equal to 27,273. So the total now is 44,636 and this is 45,364. Okay. So this completes our exercise, and we can once again put this information in an Excel sheet in case you find difficult to read my handwriting. Finally, let us solve an exercise on recording journal entries on revaluation of assets and withdrawal of partners under different conditions. Now, Kazma, Folkert and Tucker are partners with the capital account balances of 30,000, 75 and 45 respectively. Income and losses are divided in a ratio of 4:4:2. When Tucker decided to withdraw, the partnership revalued its assets from 225 to 252. That means the assets has been revalued and increased by 27,000. And this increase is because of increase in the value of inventory of 8,000 and an increase in the value of land by 19,000. So 19 plus 8 is equal to 27. Tucker was then given 15,000 cash and a notes payable of 40,000 for his withdrawal from the partnership. Prepare the journal entries to record the revaluation of the partnership's assets. Prepare the, okay, so let us start with part A. We have to prepare to record the revaluation of partnership assets. Now, inventory has been revalued and increased in value by 8,000 and land by 19,000, and this will be distributed among the partners so that this total is 27, and this will be distributed among the partners in the profit sharing ratio, that is 2:2:1. So that makes 10,800, 10,800 and 5,400. Now if we Go to part B now. Prepare the journal entry to record the withdrawal using the following independent methods. First one is the bonus method. Now, they are paying the retiring partner Tucker 15,000 cash. They are paying them 15,000 and a notes payable of 40,000. So we have a total of 55 now, and from this 55 you can see that the Tucker capital was credited by 5,400. So Tucker's capital will be now 55 is the total, and from this 5,400 for revaluation, so that makes it 50,000. How much? 45 plus 5. Sorry. The total is 55,000, and the Tucker's capital of 5,400. So 45,000 is his capital plus 5,400. So that makes 50,400. 45,000 is in the balance, and 5,000 for revaluation. The total becomes 50,400. But he is actually paid 15 plus 40, that is 55. That means there is a difference of 4,600, and this is going to be paid by the allocated to the two partners capital account by debiting them, and because the ratio will be equal now, so that is 2,300 in either case. Next we go for the partial equity method, and if you have to go back to my previous video to look into what is partial equity, because under partial equity method we record only the goodwill that has been purchased, and the goodwill in this case is how much? 15 plus 40 is 55,400, and his capital was 50,400. So the goodwill purchased is 4,600, and Tucker's capital will be credited by this amount 4,600. Now we are settling his account, so Tucker is going to be paid 55,000. We have already paid him 15,000 cash, and we have issued him a notes payable of 40,000. We go to the third part, that is full goodwill method. Now under full goodwill method, the goodwill we have purchased is 4,600, and that is for 20%. 4:4:2, so divided by 0.2, so the total goodwill would be 23,000, and this will be distributed among the partners in the ratio of 4:4:2, that is 9,200, 9,200, and 4,600. So Tucker's capital is again debited by 55,000 because we are paying him cash 15,000 and issuing a notes payable of 40,000. Once again, I have put this exercise in an Excel sheet. in case you find my handwriting difficult to read. So this completes the video on solving of exercises on formation of partnership. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Thank you so much and happy learning.